All right, welcome everybody. Shane Carter here, Hampshire Capital. With us as always, my partner and VP of Investor Relations, Eddie Austin.
How we doing?
I'm doing good, Eddie. How you doing, buddy?
Man, I'm doing great.
All
It's
right.
a great day, and it's also a very cool day to look at other types of investments.
Yes, yes. So we're going to be talking about RV parks today, and we're going to be talking about them because we're finishing our fund PPM and Narrative, and we are multifamily guys first and foremost. But this being kind of mid 2023, there's a bit of a lull in the marketplace, and we've found some niche operators and some statistics around RV parks that we're particularly excited about and interested in, and we want to share that with everybody here today. Because we will be making that a part of our fund, that our fund will be allowed to invest in opportunistic areas for RV parks where we believe and know that we will be able to achieve outsized returns that are risk adjusted substantially better than multifamily. So it's an interesting asset class that we've been studying, and we wanted to share some of those stats and some of why we believe in it as an asset class.
Yeah, I got to share something real quick. I had someone approach me the other day. They said, why in your fund do you have land entitlement and raw land opportunities in your fund? And, and you do multifamily. So why are you a little bit misaligned on just doing multifamily? And I said, I look at it like the McDonald's method. And they said, what do you mean by the McDonald's method? And I said, so they pay for all the land that they own by flipping hamburgers. It's a business model.
Yeah.
And I said, but for number one is we want to own the land. We want to own things that they're not making more of. So for me, as long as we're good operators, whether that's multifamily or it's land entitlement, I want to own the land. And just like for RV parks, we're looking at the stats today from RV parks, and it's impressive. It's not a guarantee, but it's a really safe bet that you could buy RV parks and you would own land. Again, they're not making any more land. And, someone else can pay for that, and it gives really good returns because we're always strategizing how we can give better returns than other people in the market. How can we be the most attractive fund out there? And for us, it means a lot to give the best returns to our investors.
Absolutely, 100%. And so, and again, we would not be, the primary operators. We would focus on, and we've got it down to just one or two different niche operators that 100% focus on this asset class, and they would become our operations partners in the assets. Right. Because like any business, it's all about the people, and it's all about the implementation and the system and process of how to really optimize the investment business. But there's one group in particular. I won't name any names, but we've had a number of conversations with them, and we've continued to vet them, and we've come away sufficiently impressed with their track record, their industry knowledge, and their ability to scale, which is a number one factor for us when making an investment like this. It's great to make one investment here or there. But we're generally talking about smaller dollar amounts than we are with multifamily. So we really want to be able to, buy at scale where we can buy 5, 10, 15, of these parks and really get it to a scale that would be that would equal multifamily. Although interestingly, our minimum metric is 100, sites for RV parks, right? So it's not unheard of or uncommon to get a 200, 300, 400 unit or site park. And look, these rents can range from, on the low end, $350 to some of the high end over $3,000 a month. Now, that's a super luxury product. That's not necessarily going to be our focus. But if let's just say we're in the middle there, if we're in that sort of $600 to $1,500 a month, well, look, that kind of starts to sound like an apartment rent, right?
Right, it does. And the really cool part is if we look at apartments, most of the time you're between $2,000 to $3,000 per door in expenses when it comes to multifamily. And it could go up to $4,000 a door depending on its location. So I seriously doubt that there is even anywhere close to $500 of related costs when it comes to a pad. So the pad that RV is parked on, you're not maintaining a roof, you're not maintaining drywall paint, an air conditioning system. So those costs are tremendously lower as far as ownership expenses.
Yeah, that's right. Yeah, the infrastructure is in place, and it's really just a kind of replacement reserve or maintenance reserve for your infrastructure for your site. You got your amenities, you've got your kind of clubhouse, pool, stores, and sort of accessory amenities that are around a well-run site. But you're right, the OPEX ratios are lower as well, and so there's in general greater return metrics that are able to be seen in RV park investment versus multifamily investment. And the fantastic thing too is that lenders and institutions are now just starting to come around to being able to finance these. So we're being able to get really favorable debt terms from larger institutions, which is a sign that the asset class is maturing and it's being taken seriously. But we're still at the beginning of this cycle of growth for RV parks.
Absolutely, yeah. I think it'd be a great time. Let's get into some of the stats that we looked at earlier.
All right. So some of the stats that we feel make this a particularly compelling investment are. Let's start with what do we have right now? What's out there? There's approximately 16,000 RV parks in America. Okay.
That's crazy. If you think about across America, like
all of America,
16,000 is just nuts.
That's it.
I mean, I wonder how many apartment buildings there is in the United States.
Oh man, you put a couple zeros on that, right?
I guarantee it.
And so there's 16,000. So this is again, it's sort of a smaller class, but here are the interesting things. Of the 16,000 units, 97% are kind of mom and pop owned, privately owned, right? So that the large people who can aggregate 10, 20, 30, 40, 50, 100 of these communities together of ownership, they're very, very few. There's a very, very few amount of folks who are doing this in any relative scale at all. And so the opportunity for grabbing market share is massive. And you've got most of the by far the largest percentage of the owners of that 90% what we call mom and pop ownership, are boomers. They're in their aging years, and this is sort of a lifestyle / retirement move for them, or it was passed down, from a generation prior, and maybe they don't necessarily want to run as well. The point is, there's a lot of opportunity for these types of assets to trade hands in the relative near future. And just some of the data that we have from our operations partner show that the success ratio for acquisitions in terms of calling to parks and getting a litmus test of who's interested in selling and at what valuation and whatnot, a very high percentage of those calls are being taken and are turning into potential leads. Versus you call 100 multifamily owners right now, and you're probably going to get maybe one that would be interested in selling, right? And so life, especially when you have smaller ownership groups, life events happen, and they're just more prone to wanting to sort of cash out, take the chips off the table. Maybe they bought it 10 years ago and things were just different then. And, it's their time to move on.
Right. Well, if you think about it, probably some good bull cycles gave them a lot of money, and they probably exited the stock market and probably bought these things up, or say they got out of the military and invested everything, or they retired early and pulled 401ks out, pension funds out. They purchased this mobile home park, and now, they're wanting to free themselves up, because those types of people are definitely boots on the ground. So they like to be there with the daily management. They want to be there 100% managing that asset class. And now they're probably thinking, you know what? I want to go to the Keys. I want to get me a sailboat, and I just want to relax.
That's right. And so a couple other statistics that I found particularly interesting. So let's say that the average size, just for our 16,000 parks, let's say that the average size of a park is 100 sites. There's certainly a lot of parks out there that are 16, 20, 30 site, RV parks. And then you got some of the newer ones that we've seen in Texas and Florida, that are 400, right? Plus units that are being developed today. But let's set the development aside, because that's a whole other avenue of that I think is interesting. And it's interesting because let's say we took 100 sites at the 16,000 units. That's an average, or that comes out to about 1.6 million of RV sites. Let's say we're off a little. Let's say on the high side, maybe it's 2 million RV sites in America that are available, right? Guess how many households currently own RVs in America, Eddie?
Oh man, I wouldn't even want to take a shot in the dark at this one.
11.2 million.
Holy cow! See, I was thinking in the hundreds of thousands.
So we've got 1.6 to 2 million RV sites out there, and we've got 11.2 million households that own RVs. And additionally, statistics that we found project in a recent poll that there's an additional 9.6 million households that intend to buy an RV in the next 5 years. So that existing pool is expected to double in the next 5 years, and it's already, approximately 5x more than the capacity that we have in RV parks. So what does that tell you? There's a severe supply-demand imbalance, and number one, we need to create more supply. We need to develop more RV parks. But number two, there's a burgeoning opportunity in acquiring RV parks at scale, really implementing a systematic approach to management, to branding, and to experience. And when you have 97% of them that are owned by mom and pops, well, as you can imagine, the unique thing is that each one maybe has its own feel, its own vibe, because the ownership is different. However, most folks who are polled, look, why are there so many Chipotle's and Taco Bell's and fast food chains, and why are they all the same, and Subways, right? And they're all the same wherever you go. If you're in Washington State or Washington D.C. or Arizona or Maine, it's literally the same experience inside that store. Right. And it's because there's a recipe and a system and process, and you know what you're going to get, and that is very comfortable to most people in general. Right. And so, yes, there's KOA. That's a big brand. Right. And so that's a franchise that franchisees have to pay for. And there's a specific experience that you would get at a KOA campground or RV park that would be different from somebody else. But, we believe there's a tremendous opportunity in that to create a standard, a gold standard, a best in class standard, similar to a KOA brand. But potentially to surpass that brand, because we're not looking to franchise. We're just looking to own the assets and take, an existing park that's poorly run and implement our sort of corporate level strategy planning and processes to create a unified experience, upgrade all of the amenities, just like in an apartment, value add process. Step one, improve the grounds. Make sure that there is, A-grade class Wi-Fi throughout, that there's an amazing pool or water experience, whether it's a pond, a lake, or a pool experience. Make sure there's an amazing sort of clubhouse, gathering space, flex space, vendors, et cetera, et cetera. The experience in the community is top notch. And then, again, there's a standard accounting, there's standard software, there's standard implementation for management, marketing, branding, internet, et cetera. It's all standardized, and you can really create a lot of value even in existing assets. And then, we target assets where there's maybe a room for expansion, so that we can continue to add value because of our development expertise. So there's a lot of upside in how we acquire assets. And the thing that really got me is that the sort of going in cap rates and the value creation that we have going in and buying these RV parks is about 2x better than a multifamily asset right now.
Oh yeah, And, it's a different model, but I've heard so many investors that would go, hey, I own a mobile home park. They're not proud of owning that, but it's a cash flow monster. And
Absolutely.
this, is an asset I think that fits both, because I would be proud to say that we own such and such RV park.
That's
and
right.
It's in Clearwater, Florida, or something like that, and it's got a pool and it's got a nice clubhouse and all these things, and it cash flows very similar to the mobile home park, except it's a little bit better asset class.
The cash flow is amazing. And I think that's something that our investors are going to really appreciate, especially because we're putting it into the fund model where you're going to get a balance of some of the perceived stability and performance of our value add multifamily, as well as some new A-class multifamily. But then you get some of this land development and some of these RV park investments that are really giving outsized returns in terms of the capital appreciation and velocity of capital, and the equity multiples and cash on cash returns for those assets is frankly quite literally about 2x what we're used to in multifamily.
Right.
And so the blended balanced portfolio approach of our fund, I think, is going to be brilliant for our investors, because it is balancing that risk and reward and that performance accordingly.
Well, let's talk about how we derived at this location right now, because we were looking, and we did a previous YouTube video on this, or podcast, on expected returns for 2023. And they're a lot different environment. So if we were singly focused on that asset class, which is multifamily, we would have to educate and coach our investors that returns are not pre-2019. They are not 2020. The asset class is different. It is a different season. The interest rates are different. And all these things have changed. And there's some investors that's like, I'm just going to wait. I'll just wait until it comes back. And I don't think waiting's the right thing. I think that, look, we know for a fact that they're not making any more land. I can't say it enough. And then the second thing is smart operators can generate returns in all types of weather climates. We can figure this out. And that's what we're doing here is we looked at what we were doing. We instantly added the land entitlement arm because we knew we could generate better returns than multifamily. And it's a good stability to have the asset mix of the land entitlement plus the multifamily. Now we adopt this, across the board. When somebody says, well, I don't want to invest in a fund because it's not as diversified as a mutual fund. Oh, actually it is. We invest in real estate. Yes, it is only real estate opportunities, but we invest in multiple asset classes and multiple states.
That's right. And, I think one of the beauties too of owning, these RV parks and doing these land developments is really, like you said, that we're really targeting, target specific locations near major MSAs in the RV park side, near major, attractions, so that we know that we've done the market research to identify pieces of land in and of themselves that we're acquiring at a basis that we know we're going to make money at the end of the day, either way, right? Now we go through the value add process of, in the land entitlements, changing the zoning, creating additional entitlements for multifamily, for industrial, for single family homes, and selling those into the ecosystem. And we're creating huge value in doing that. On the RV park, same thing. We're acquiring these from kind of mom and pop owners at a massive discount. So the basis on the existing cash flow is fantastic. And then we just grow that cash flow and we still have that same basis. So the outsized returns are massive there. And again, it's a balanced portfolio where we're not going to lever, too heavily in any one direction. Well, we are going to predominantly, buy multifamily assets, 100%. That's going to be the bulk of what we utilize the funds for in our fund. Which frankly, as we sit here in the middle of 23, we believe strongly that coming towards the end of this year and the beginning of next, we are going to see some amazing opportunities continue to come up, even though we still see them today. They're a little few and far between right now. They're a little scarce.
Right.
And our relationships with brokers and our relationships with sort of direct to folks who are direct to, ownership groups allows us to, be at the front of the line to see these opportunities. But the reality is there's going to be, I think we believe, a lot more coming in the next 6 months. And we want to be properly capitalized to take advantage of those opportunities in multifamily, as well as we continue in the land development and RV park side.
Absolutely. I mean, look, last week we evaluated 6 deals. We evaluated 6 different multifamily deals, and we did not submit an LOI on any of those. Now we will submit this week on 2 deals that we're looking at.
Yes.
But it's not that we're not looking. We're beating the bushes down, and we're spending a lot of time doing that. But we're not finding assets that we are comfortable with enough that we can know that we're going to give good returns to our investors. So why would we even shoot for something that's subpar, in our opinion?
Yeah, that's right. And frankly, we're in a position as a company and individuals that we really don't have to buy anything, right? We're under no pressure or stress to buy. We are diligent investors. We only will purchase when it's in our buy box, and we're not going to stretch that. We're not going to stretch to try and make a deal work. It either works or it doesn't. If it doesn't hit our parameters, it's just a no, and we move on. It doesn't matter. If we haven't bought an asset in 6 months, that's fine. We will wait because we'll know that we'll be able to buy, 4 assets in the next 6 months, right? And it'll just, or 6 assets in the next 6 months. And it'll more than make up for the fact that we haven't bought one in the last 6 months, because frankly, we're not going to stop being conservative. We're not going to stop being prudent investors, and we're not going to change our buy box. In fact, if anything, we've become more stringent in our buy box because of these times and because of the capital markets conditions, both debt and equity. We want to make sure that if we bring something forward to our partners, that it really is an amazing opportunity that we have fully vetted 100%.
100%. I mean, it's so true. I mean, it's all over the news. It's all over social media about multifamily and its negative downfalls and stuff like that. But I told a guy the other day, he's like, man, how do you vet this out? How do you know your investors are safe? And I said, we know what we know, and we do not buy in desperation. We will buy when the season is correct. And I said, we're still looking at assets. We're still active. But we're not going to stretch ourselves too thin and just buy something because we just got to buy something. We don't get excited to the point like we got to go buy something. No, we don't do that.
We don't do that. Absolutely not. We're gonna stick to our principles, stick to our criterias, and we're only going to buy when it's an absolutely good opportunity. And in this day and age, it means a really good basis story, a really good story about value creation and upside. And or a necessary component of intelligent debt, an intelligent capital stack arrangement that puts us in a favorable leverage yield. And those are the 3 things that have to be in place for us to want to play ball on any multifamily deal right now.
Yeah, and to go just one step deeper, not to go down the rabbit hole, but that same person asked me the next question. He said, "So what are you guys doing during this time?" I said, "We're improving systems and processes. We are critiquing our operation to maximize our performance."
That's right.
And he goes, "So you're just not sitting around taking vacations?" Like, heck no.
Nope.
No, man, we're like really digging in, figuring out everything that we want to figure out, learning what we don't know, and improving our processes, and really digging deep on systems and processes and making our operation just top notch.
Yeah.
And, for instance, we're implementing that all over across the board, and it's working out well. So when we do buy that asset, we can put in things that just haven't been done yet, or we're top-notch operators.
Yeah, and I think we all talk about this. Certainly Nick and I talk about this a lot. That the sort of the last, we'll call it the last 7 years. We'll call it the 2016 or 2015 to 22, really anybody, frankly, and this has been proven many times, right? Anybody could have jumped into this industry and just paid market pricing in 2016 and then sold it in 2019 and looked like a hero.
Oh, God.
Without ever knowing how to asset manage, without being diligent, just give it to a good property manager and just let the ball roll, right? And you just had massive market appreciation. Well, guess what? These next 7 years from, I'm going to call it, 22 to 29 or 23 to 30, these next 7 years are going to be the years of the diligent asset managers, the diligent operators, the hands-on guys and gals that really know how to run an asset and then have the system and process. And so, Hampshire Capital will be a 10,000 plus unit firm in this time period. And we're just about 25% of the way there. So now is the time for us to really refine and improve our operation systems, performance, and our EOS system to ensure that as we scale intelligently and we scale with an eye for really diligently managing the KPIs that are required of management in this day and age, which is not a rapid, market appreciation time frame. This is a forced appreciation. We have to create the appreciation that we want to see, and it has to be done with an intelligent return on cost and yield on cost for those capital expenditures and investments.
Absolutely. I think Warren Buffett says it best is, when the tide goes out, you find out who's swimming naked. Well, the tide is going out right now.
Yeah, the tide is out. Yeah, and it's going out.
It's going out. And it's receding every day, and more people are being exposed every single day.
That's right. Yep.
Well, I can't say it enough. If anybody wants to find out more about the company, please go to www.hampshirecap.com and schedule a call. Download the ebook. Check us out. Go check out our Facebook page, our Instagram, our LinkedIn. We've got every platform, guys. Go check it out. And get a hold of us. We're happy to jump on the phone with you. We're happy to educate you. Jump on a Zoom. And also, if you want to jump on our podcast and be a guest, come on down. We want to, be a part of this community. We want to grow other people. We want to grow investors. We want to grow our partners. And we're here to help. So please, by all means, get in touch with us. Start by liking and subscribing to the channel. And leave us a thumbs up and tell us how we did. Give some communication. Get involved. And again, always, anybody has an idea on something we should talk differently about or a little more in depth, please, by all means, leave us a suggestion.
Yep, absolutely. All right. Well, thanks again, Eddie. Another great episode. I appreciate it. We'll see you on the next one, buddy.
Absolutely. Have a good day.